Qualcomm just reported, and guys, it's the semiconductor, it's the chip industry. Guess what? It was huge. Look at these right here, guys. Revenues, $10.9 billion versus $8 billion last year, 36% increase. Earnings before taxes, 4.2 versus 2.2, 88% increase. Net income, 3.7 versus 2, 84% increase. EPS, 329 versus $1.77, another 86% increase. Guys, that's huge, but why is that? I just did a video on Pfizer, and the same thing occurs. We're in what I believe to be a temporary chip shortage. Demand is high, supply is limited, so what happens to revenue and profit when that happens? It goes up. So the question you have to ask yourself is this going to continue? So if you're new to this channel, and this is your first time watching a video, or very early on, I'm Paul, I'm a value investor. I don't take a company's most recent results and extrapolate it to the future. I don't extrapolate anything from the future except for what I see in the long term. When things occur, I ask, is this sustainable? And can we grow from here? And even if you can't grow from there, I can still value it if it's sustainable. Every investment is the present value of all future cash flow. And if I can't reasonably determine how much the company will likely make in the next 10 years, I will probably avoid the investment. Now, that makes me avoid the hype stocks, but I'm okay with that. With Qualcomm, let's go pull up Qualcomm right now in our stock analyzer tool, on our software. And if you belong to our software through everythingmoney.com, please follow along. It's a great way to get used to the software totally. So the stock hit a high of 194 in the last year and a low of 120. And that low was back in June. It appears to be. It's now at 146. But let's look at their income statement to show their revenues. Let's go back to 2016, 22, 23, 22, 21, 24, 29, 39. And when did the chip shortage happen? Right there. Okay, so you got to ask yourself, is Qualcomm going to be able to sustain this chip shortage revenue and earnings bump for a long time? If you say yes, then evaluate the company based on that. Me being a conservative guy, I want to make reasonable and conservative assumptions in a company and buy it at a discount to that number. So let's go through the Qualcomm numbers. Let's look at this 8 pillars right here. And we're going to go through these numbers right now. So even with this big surge that I think is temporary, look at their 5-year PE and 5-year price of free cash flow on their 8 pillars, 39 and 29. Guys, that's big. This means that they have to extrapolate out this revenue growth and earnings growth for a very long period of time to justify these high earnings multiples and free cash flow multiples. The more growth the company has, the higher multiple you can pay. But Qualcomm's a huge company. They did $39 billion in revenue. Are they going to grow at 40% a year? No. Are they going to go 30% a year? Probably not. Let's actually go look at what they've grown in the last 10 years. So let me go to our stock analyzer tool where it shows these numbers. Revenue growth over the last 10 years was 6.8%. And that includes a 33% jump last year. That alone was 2 or 3% of that 6.8. The profit margin, big profit margin. Like I said, why is that? Because increased demand and limited supply drives up profit and revenue. They can charge a higher price. Free cash flow margin actually is lower, but that could have something to do with their capital expenditures. Because remember, free cash flow is cash from operations less your capital expenditures. So let's go look at their cash flow statement here on our software. And look at this, guys. Look at their capital expenditures. 800, 800, 500, 850, 700, 1.2, 1.72. So in the last 3 years, they've really skyrocketed their capital expenditures, probably because they want to keep up with chip demand. And don't forget, as the world develops more and more and the world becomes more and more chips will be required. We're doing more and more every single, look at this. 20 years ago, how many people had a cell phone? 22 years ago. Now, how many people have a cell phone? How many more chips are we using now than we did 22 years ago, right? But remember, extreme caution. Look at Intel. Intel hit $75 a share back in 2000. It has not touched that number since. It is currently in the high 30s somewhere. That's very, very intriguing to me. So let's go sit here and go through our stock analyzer tool. Now, what the stock analyzer tool does is it takes our assumptions on the future and brings it back to today to give us a price that we want to pay for the stock based on those assumptions, right? So when you make your assumptions here, Think about it. Don't just willy-nilly go, oh, well, they did 6.8% last 10 years. They'll do it again. Maybe they will. I've been wrong before. I assessed Amazon 10 years ago on revenue growth that I never thought they'd get, and they got it. Okay, I missed out on Amazon. You might sit there and say, you idiot. I sit there and say, okay, I missed out. Because my goal is not to miss out on the Pelotons and Palantirs and Coinbase and the other stocks that have fallen 70, 80, 90% in less than a year. So let's go in here and do our 10-year analysis. In our software, you can do up to 20-year analysis. So guys, I'm going to go with 2, 4, and 6% revenue growth. Profit margin, I'm going to do 18, 20, and 22. Free cash flow margin, I'm going to do 20, 21.5, and 23. PE, 14, 16, 18. And I'm going to do the same thing for price to free cash flow. And finally, guys, I'm going to do a 12.5% return because you can get the market rate. You can get 9 or 10% just by buying a low-cost ETF. So give yourself some margin of safety and a reason to buy the individual stock. So guys, I'm going to hit the analyze button. Now here's what's going to pop up below. It's going to pop up 6 numbers. Some are going to be red, some are going to be green. Maybe they're all red, maybe they're all green. I don't know. If they're all green, it doesn't mean go out and buy. It means go make sure these assumptions were correct. If it's all red, it doesn't mean avoid like the plague. How far are they from these numbers, from where the stock currently is at? If it's close, add it to your watch list here. You can add it to your watch list using the plus mark, and that'll notify you on the phone app as well as email and on your computer to tell you when the stock is hit. So we hit the analyze button. The stock is currently at 146. All right. So on the low side, has to fall in half. High side, it's almost there. It's $10 away. In the middle, right around $100. So me being the conservative guy that I am, I'm going to mark it at 103.31, and I'm just going to change this to 100 and notify me when it hits below 100. So if you like this video, do me a favor. Subscribe to the channel, and then watch this next video on our full 8-pillar process. You'll really enjoy it and learn a lot. Thank you very much for your time.